Welcome to our webcast on employee retention credit. My name is Dave Ogburn, and I'm with Bank New York Mellon in San Francisco, and I have the privilege of being your co-host this morning. I'd like to introduce our main presenters here. So I'll start with Brett. Brett is a director at BPM. He has over 20 years of advisory experience, as you can see by his bio, across many sectors. And most importantly, he was a busy man this past year as he led BPM's PPP efforts. I think you get a gold medal for that, Brett, just given everything that was going on over the last 10 to 15 months. But also, I'd like to introduce Andre Shevchuk, who's a partner at BPM, and most relevant to this call, leads BPM's specialized tax practice, which includes their R&D tax credit consulting practice. And much like Brett, Andre also has many years of experience advising clients across the board, across many industries. And then, as I mentioned, my name is Dave Ogburn. I do two things at Bank New York Mellon. One, I lead our endowments and foundations practice, and I also lead our private advisory practice, which advises entrepreneurs and founders.
So the intent of the employee retention credit was a response from the federal government through the CARES Act to encourage businesses, especially small businesses, affected by COVID-19 to keep employees on payroll. As we know, the CARES Act was a $2.2 trillion stimulus bill enacted in response to the pandemic. The CARES Act was passed back in March of 2020. Effectively, the employee retention credit, it's a refundable payroll tax credit. So it's claimed in your payroll tax return. This is not a income tax credit, which sometimes folks get confused by. So it's rather, like I said, a refundable payroll credit that's filed on your payroll tax return, which is a quarterly filing. So that's on Form 941, which you may be familiar with. Along with the employee retention credit, through the CARES Act, there were a lot of significant stimulus spending. There was $300 billion for the one-time cash payments. Those are the $1,200 checks. There was $350 billion for state and local governments. There was $500 billion allotted for loans to corporations. And there was almost $700 billion for the creation of the very popular Paycheck Protection Program. So those are the forgivable loans that you may be very familiar with. The PPP loan element here is an important discussion because initially with the CARES Act, it said that you were, if you were to get a PPP loan, you were not also eligible to claim the employee retention credit. So this caused a lot of our clients to more or less ignore the retention credit initially because so many were pursuing the PPP loans. It wasn't until the Consolidated Appropriations Act that was passed in December of 2020 that Congress did away with that restrictive provision. And it made it so that taxpayers can benefit both from PPP loan forgiveness and from the refundable employee retention credit. So Brett, I don't know if you want to chime in here a little bit with your experience with PPP and kind of talk about what you saw there.
Yeah, thanks, Andre, and everyone. Happy to be with you this morning, particularly as we kind of make this transition. As Andre said, we did a lot of work for clients on the PPP. We touched over 300 clients, addressing questions, doing webinars, those types of things, and we supported over 100. With direct work, including applying for their loan forgiveness or even their application up front. As we've started to transition out of that work, as most folks are kind of wrapping up or have already completed their loan forgiveness applications, they've started to dive into the ERCs with the change that Andre has talked about at the end of the year. And so that question has started to come up a lot, and I've been interacting with a lot of folks. And so Andre and I have been talking, and it kind of part of the genesis for this conversation today is that a lot of folks have realized that, hey, maybe there's some opportunity that we thought wasn't available for us. So we're definitely seeing kind of the same thing, and Dave hit on it for sure, that this is a topic of interest, and we're certainly hearing it from clients. And so happy to be with you guys and kind of dive into that today.
Great. Yep. Thank you, Brett. I know we've had a lot of experience with the PPP and the ERC. So let's continue. So let's stay on this slide here. But so let's talk about what the value of the credit is. So there's this component of eligibility, but and we'll get into the eligibility definitions quite a bit here. But initially for 2020, the employee retention credit is a 50% credit, and it's captured on the first $10,000 of a combination of gross wages and employer-paid healthcare expenses. So this produces the maximum credit of $5,000 per employee for the entirety of the 2020 year. So now in 2021, the rules changed and the employee retention credit gets increased to a 70% credit. It's again captured on the same first $10,000 of a combination of gross wages and employer-paid healthcare expenses. And this produces a maximum credit of $7,000 per person, but now it's per quarter. So this is a huge distinction because the employee retention credit just becomes so much more generous in 2021. We can go to the next slide. Okay, so on this slide, I wanted to simply point out just how much more generous the credit can be to a small business in 2021. So in this case, you can see we're using a 10-person company as an example. And in this scenario, they're hitting the maximum qualifying wages for all 10 employees. In this simple calculation, we're also assuming the taxpayer is eligible for all of 2021 and all of 2020. So in this case, you can clearly see that the maximum credit of $280,000 in 2021 is just so much more valuable than the maximum credit of $50,000 in 2020. So it's a really important distinction. We'll have more examples of definitions to go through, but at a very high level, this just speaks to how much more generous the credit becomes in 2021. Now let's talk more about the differences between 2020 and 2021. So on this slide, we can see the key changes that we'll discuss in subsequent slides. But we will first start by talking about the eligibility requirements. The eligibility requirements are pointed out here a little bit in reference to the gross receipts test. We'll also need to discuss what limits there are for what Congress considered what is a large employer versus a small employer. And finally, how does receiving a PPP loan interact with your employee retention credit calculation? But here you can see the key changes to the employee retention credit from the CARES Act to now the Consolidated Appropriations Act that was passed in December of 2020. Okay, so now let's talk about how to be eligible to claim the employee retention credit in the first place. Starting in 2020, there's two paths to eligibility. The first is if your company experiences a 50% decline in gross receipts compared to the corresponding quarter in 2019. So for example, if in Q2 of 2020, your gross receipts declined by 50% or more when compared to your Q2 2019, then you are considered eligible. If you do not meet the decline in gross receipts test, the other path to eligibility is when your business was fully or partially shut down due to government order. In 2021, the gross receipts test becomes more relaxed. So you only have to experience a decline of 20% or more when comparing your 2021 quarterly gross receipts to your 2019 quarterly gross receipts. It's important to pause here and acknowledge that this is an either or test. You don't have to meet both tests. So with that being said, it's so much more straightforward to be eligible using the gross receipts test because it's black and white. There's no subjectivity. Whereas the partially shut down eligibility is so much more subjective. And we'll get into the examples the IRS has provided as guidance to show you how to interpret what is considered partially shut down or not partially shut down. There's an added caveat here, which is a bit confusing, and I had to sort of mention it here, but to determine your Q2 2021 eligibility, there was another piece of guidance. So instead of comparing your actual Q2 quarterly gross receipts to your Q2 2019 quarterly gross receipts, you can look back to the Q1 and see if you were eligible then. And then that will allow you to be eligible for Q2 of 2021. And the reason I think that the IRS wanted to do this is so that people can access the eligibility or recognize that they're eligible much more quickly. But with some of these things they try to enact, it makes things more confusing. So basically, it's everything. So we've broken out a distinction between the definition for a for-profit company and a nonprofit company. So nonprofits must also account for contributions and gifts in their definition of gross receipts. So that's a question we would get sometimes is do we have to account for this? Is this considered revenue? So it's usually more straightforward, and we don't get too many questions about this, but one thing that is worth noting is that you don't have to change the way you account for revenue in your evaluation of this test. So meaning if you report revenue on a cash basis or on an accrual basis during the normal course of your business, you don't do anything different when you are accounting for the gross receipts to meet the eligibility test here. If you do not meet the decline in gross receipts test, and if you are still potentially eligible if you were, like I said before, fully or partially shut down due to government order. And this test, like I said before, is tricky because it's subjective. So what does it mean when we say partially shut down? So thankfully, the IRS did produce quite a lot of guidance in the form of frequently asked questions. In fact, there's 94 FAQs that the IRS have listed on their website. And many of them focus on the partially shut down eligibility rules. So let's talk about it. So first, we can talk about what kinds of government orders qualify. As you can see here, there are some examples provided, but for us in California, this was fairly clear in the stay-at-home order that was issued on March 19th of 2020. Everyone was sort of affected by that. So many of us can think about how that order may have impacted or impaired your business's operations, and that's sort of the start of what is considered partially shut down. Now, the real trick is to determine what is considered partially shut down. And I'm going to go ahead and read from this slide. So the IRS says that an employer that operates an essential business is not considered to be partially shut down if the government order allowed the employer's operations to remain open. So this makes sense, right? You're not impacted. However, if an employer that operates an essential business may be considered to be partially suspended operations if more than a nominal portion of the business operations are suspended by that government order. So for example, if a business was considered being partially shut down, if a government order restricted that operation. So what is a nominal portion? There's a definition there, and the definition is the gross receipts from that portion of the business that was shut down is not less than 10% of the total gross receipts of the business, or the total hours associated with that portion of the business is also not less than 10%. So you're getting affected somehow by 10% or more. So to put this in context, I think a good example is an example of a winery. So the concept is for example, during the pandemic, we have a lot of wine clients, and we saw that wine sales were continuing, but the tasting rooms were shut down. So if the revenue from the tasting room represented 10% or more of the revenue of the winery, then even though you're still continuing operations, if that portion was more than 10%, you are partially shut down, and then this would get you to be eligible for the retention credit. So hopefully that makes a little bit of sense. Okay, so when looking at examples provided in the IRS's FAQs, there's a lot to review. I've cherry-picked a few examples which were important because they highlight what kinds of storylines Congress and Treasury were thinking of when they were trying to direct this employee retention credit eligibility. So we have here as FAQ 31 talks about an auto parts manufacturer. So it's an essential business. In this case, in this company's case, the raw material supplier was shut down, and they were not able to locate materials elsewhere. So in this scenario, they are considered partially shut down, and therefore they're eligible to pursue the credit. So they're really impacted by this. FAQ 32 is now it's an auto repair service. Again, it's an essential business, and the business stays open, but experiences a significant decline in sales. So it's not considered partially shut down because they're still operating, but it's still eligible to evaluate the gross receipts test. So in this example, even though you're deemed to be an essential business and you are not shut down, you still could be eligible to claim the retention credit if you meet that decline in gross receipts test. So hopefully that sheds a little bit of light. We'll go through some more examples, but in this example, we have one company that's eligible because they're partially shut down. That's the first example. The second example, they're not partially shut down, but they're still may be eligible using the gross receipts test. We wanted to highlight here FAQ 33. There's examples of companies that are eligible, their continuing operations comparable to what they were doing during the pandemic. And this is a really key concept. So the first example here is a software development company. So this is kind of referred to as a telecommuting example. Here, the company is not considered an eligible, or not considered an essential business, but the business stays open, but people cannot go to the office because people were, the government ordered a shelter in place. However, people continue to work from home. So this business was not considered to be partially shut down, and it's important to remember this concept of continuing operations in a comparable manner to what was done before the pandemic. And this theme comes up quite a bit. So the distinction between comparable pattern versus disruption. So the next example in FAQ 33 is a physical therapy facility. Again, this is not an essential business. And prior to the pandemic, nobody could work remotely. They were all doing this work on premise. So after the government order, they moved to an online format where some clients may still be seen. So they're sort of continuing. But this example is considered partially shut down and will be eligible to claim the retention credit, mainly because they're not able to access a physical facility and not able to service all the clients in a manner that was comparable prior to the pandemic. So then another example is what we call here they call it a scientific research company, or maybe you want to call it a life science company or a drug developer. Again, this is not an essential business. The company cannot access the lab, and that's the main issue. So it's therefore considered partially shut down because employees are not able to access the lab and are not able to conduct their work in a comparable way. So that's these are important distinctions, and it's important for us to kind of understand these concepts when we're going through it. Okay, so now I know we're sharing a lot of examples of these companies' eligibility, but I think it's really important to talk about, really hammer them home again to highlight what Treasury and IRS was thinking about what the partially shut down concept was. So we have a few more examples, but I think it's important and relevant. So example one in FAQ 34 is a restaurant. So the Main Street types of companies are really the target of the employee retention credit to benefit them. So in this example of a restaurant, it must close for on-site dining due to government order, although they continue to do carry-out service. This is definitely a prime example of what is considered partially shut down, so that these types of companies can pursue the employee retention credit. Example two in the FAQ 34 is same facts as example one, except now it's 2 months later, so kind of following this exact fact pattern of what just happened. The restaurant is not allowed to have indoor dining, but now we're doing outdoor dining. Still, this is considered partially shut down because the indoor portion was more than a nominal portion of the business, more than that 10% of sales. So even though you're continuing to have operations, it's not in the same comparable manner as we were referring to before. So example three in the same FAQ, this is another fairly obvious one. It's a retailer, like maybe a clothing store. They maintain a website, so they're doing online sales, but people are not allowed inside the store. So clearly the business is still partially shut down because they're not able to conduct business in a comparable way as before the government order. So there are three more examples under this FAQ, and I didn't think it made sense to talk about all of them. But the important thing to remember here is the difference between nominal disruptions, which is that 10% rule, and comparable operations, which means you're effectively not disrupted by the government shutdown order. So your business basically continues to operate as it has been, and therefore you're not eligible. That's not what they were trying to do to reward companies if you're comparable. Another good example is an accounting firm or a law firm. So while we're working from home, it could be inconvenient when the dog's barking on the Zoom call. It's not really considered disruptive more than in a nominal sense. So hopefully that provides some context. Okay, so on this slide, we wanted to talk about the fundamentals. We get quite a few questions about just where to start when you're, okay, am I eligible? Now where do I start? So generally, we start with that determining eligibility, which is obviously a key concept here. But once we feel comfortable with the eligibility, the next step is to determine what exactly are the inputs? How do we capture the credit? So if your company is eligible, either by the decline in gross receipts test or by that fully or partially shut down test, the inputs are the combination of wages and allocable health plan expenses captured by person. That's important. So here we have what is the definition of what is meant by wages and what is meant by health plan expenses. The starting point for the calculation is qualified wages. So in the quarter where your business first met the gross receipts test or was first shut down due to government order, if you recall from the earlier slide, the maximum allowable wages in 2020 is $10,000. Then you multiply that amount by that 50% rate. Again, this is for 2020. So for a simple example, if anyone who's making, say, $60,000 a year in salary, their qualified monthly wages are about $5,000. So you meet the eligibility requirement, you get to the $10,000 in just 2 months of the quarter. So relatively quickly for somebody who is, a $60,000 salaried employee. So you get to the maximum fairly quickly in 2020. Again, citing one of our earlier slides, in 2020, it's a 50% rate. So it's only a $5,000 credit per person for the entire year. If you're calculating credit in 2021, the maximum qualified wage threshold stays the same. It's still $10,000, but the credit rate increases to 70%. So the maximum credit per person is now $7,000, but now it's not just for the year. For each quarter, you can recalculate the credit. So it's way more valuable. We'll elaborate on this a little bit and have time for a few questions, but you can just see how quickly you can max out the credit for each individual when they're paid sort of at a $50,000 to $60,000 to $70,000 rate per year. So what is a small business? Critically important concept to understand because it really changes the credit dynamics and it's a bit confusing. So a small business is employers with total full-time employees of 100 or less in 2019. Now this is a 2020 definition. So the definition changes for 2021. So initially under the CARES Act, a small business was this 100 person or less in 2019. For 2021, the definition of what is considered a small business grows to 500 or less. So the credit again is much more generous. The populations are much larger. If a company is not a small business by that definition, the credit is calculated only on the employees who are not providing services to the company. So what does not providing services mean? So a good example here, I had to come up with one of my own, is a tech company. So a large tech company with more than 500 employees, they're able to claim the retention credit, say they're eligible, but because they're not a small business, they only calculate the credit on the employees who are not providing services. So in this tech company example, say they had a cafeteria on campus. So none of the staff in the cafeteria are working because no one's there and there's not really anything for them to do. But say this company was very generous, kept them on payroll and wanted to wait it out. These are the people that you calculate the credit on if you have a more than, say, 500 employees in 2021 or more than 100 employees in 2020. Super important concept because it changes the credit from being very, very large to perhaps very, very small or maybe non-existent. So it was a bit surprising to me, but a lot of our companies were right around that 100 employees. So determining exactly how many employees they had by this definition was critical. So for example, if you have just under 100 employees, the retention credit could be close to, say, $500,000. And if you were over 100 employees in 2020, you basically got little credit or nothing at all. So what is the term full-time employee? It means an employee in a month. In any month in 2019 clocked an average of 30 hours per week or 130 hours in a month. In this case, the 130 hours of service is treated as a monthly equivalent of 30 hours of service per week. So that's the definition of a full-time employee, somebody who is doing 30 hours of service per week. An employer that operated its business for the entire 2019 calendar year determines the number of its full-time employees by taking the sum of the number of full-time employees in each month of 2019, then dividing it by 12. So it's a very specific calculation to see exactly how do you compute the number of employees that you need to consider yourself a small business or a large business. So this is perfect. So this is the definition of this aggregation rules we were talking about a little bit ago. So the question that Brett mentioned, are there aggregation rules? What are the aggregation rules? So yes, you're seen as a single taxpayer if you're sort of a controlled group is the term they use. So for purposes of determining employees' eligibility for the credit and the amount that you're eligible for, all entities are treated as a single employer. So there's some code sections here to refer to. We don't want to belabor this point too much, but the point here is that you're not able to claim the credits for one of your businesses if you're eligible and you're part of the aggregated business situation. And then you're saying, well, on aggregate, I'm not eligible, but this one of my businesses that I control is eligible. Unfortunately, you're kind of seen as a single taxpayer for this purpose. And you have to use that definition both for the gross receipts test and your total employees test. So it's a super important distinction there. We mentioned earlier that you cannot double dip the funds for your forgivable PPP loan and also claim a credit on those same costs. So for example here, we kind of made a very simple example, but if your total qualifying ERC wages, say it's $1 million, and you used $600,000 of PPP money to pay those wages, you have to subtract that when you're computing your ERC. So in this case, we subtract out the $600,000, we get $400,000 of net sort of wages that were paid on behalf of the taxpayer. And then this is an example for 2020. So the credit rate is 50%, and the maximum credit you get is $200,000 versus if say you didn't have any PPP funds used or you didn't get the loan, you would calculate the credit on the million. So the credit would be $500,000 versus $200,000. So this is really important because this is a very simple example. You actually have to do it by individual person and not like an aggregate like this. But the concept is that you have to separate out what you used what you used from PPP funds versus what came out of, say, your own coffers or your own pocket. So Brett, I don't know if you have any comment on this, but this is something that we have been helping a lot of our clients navigate because it's very tricky. The timing of when that money was used and how do you apply it to each individual. This is kind of where we've been really helping our clients to navigate the calculation.
Yeah, and I think it's a great point, Andre. I mean, the big thing for folks to kind of keep in mind is obviously, use as much non-payroll costs as you can, right? If you haven't yet applied for forgiveness, that kind of minimizes wages. And then, just being, very, well documented in kind of which wages you are apportioning to which program, right? Because even in theory, within the same payroll period, you could even split down to that level, Andre. I don't think I've seen anything that would say you can't. You just need to be really clear about which wages are going to which program. So I think you can be, very surgical with this and try to maximize the numbers, but, just make sure that you're well documented in how you're doing that.
Yeah, that's a key point, is this point of documentation. Like, so the documentation of a detailed calculation, these rules that are commingling with each other. And so even like, say you're claiming the R&D credit, you can't claim the R&D credit on the same wages that you're getting an ERC from. So there could be other factors when you're kind of combining all these things at once to navigate. So it can be very tricky, but the PPP becomes very tricky when, like Brett, what you're saying is that you can be surgical in how you address it and where did those funds go and how do you determine what that calculation looks like in terms of support. So this is a really, really key concept. And like we said just at the very top of this presentation, many of our clients receive PPP loans and they're going to have to now look back and retroactively claim these R&D credit, or I'm sorry, ERC credits. And in the interplay between the two, it becomes problematic. It's a lot of nuance. With the Consolidated Appropriations Act, that was the first thing that got passed in December of 2020. It only extended the retention credit through Q1 and Q2. So now with this new act, it's through the rest of the year. And I think, Brent, we've talked a little bit before about, the government shutdown orders and how that impacted businesses. And so, but what happens now where it seems like things are kind of opening up? Do we still have that same issue of being partially shut down if we are now getting back into the swing of things with more full capacity type of scenarios? So this is an important, this is really kind of important to think about now. It's like, maybe we are only really looking more strictly on the gross receipts test and seeing how did we compare currently to the 2019 calendar year, and does that still get us eligible? Because maybe it's tougher to determine or tougher to predict that you are considered partially shut down anymore, right? So if you're able to operate in a comparable setting, good for you, that's great, but we may not be meeting that eligibility for the retention credit under that definition. This was an interesting topic because uniquely, the opportunity to retroactively get these credits, typically it's a 3-year window. That's the statute of limitations on a payroll tax return. So you have a really wide window to say, oh, I might have missed it in this quarter, but I'm going to go back and get, I'm going to be eligible and I want to claim the credit. I want to seek a refund. You have a 3-year window. It's really, quite a bit of time. So a lot of our clients are often worried that they might have missed something here, but no, you still have time to claim the credit. It's much better to claim the credit on a timely filed payroll tax return if you can, but it's not the end of the world if you missed it. However, so the IRS did something very unique in that they extended the time frame of a statute of limitations. So they made it from a 3-year window to now it's a 5-year window. So what does that mean? So what that means is that the IRS is really thinking that a lot of people are going to be pretty aggressive in their claims, and they're going to give themselves much more time to pursue and seek documentation for these credits being claimed. So there's some risk there, and it's really can come back to bite you up to 5 years later. So this is a key element of what the IRS is signaling in terms of, look, we don't have the resources right now to pursue these claims or audit them in a real-time setting. We want to give ourselves a long leeway that if there are bad actors out there, we're gonna snuff them out and we're gonna audit these things. So there is quite a bit of exam risk in making these claims, and as you can imagine, these credits get very large in 2021. Say if you're a company that's 450 people and you're eligible, you're calculating a credit on everyone per quarter. So you can imagine how big these credits get, especially in 2021. So what the IRS isn't in the business of handing out free money all the time. So they definitely want to keep their options open for pursuing these credit claims. So what does that mean for our clients and prospects? It means that we need to document very well how you are considered eligible, especially if you're considering yourself eligible as a partially shut down business. If you meet the gross receipts test, I think that you have a stronger case, right? It's more black and white. It's clear cut. You have good documentation to show here's what my revenue was. I was 20% decline compared to 2019, and I'm eligible. So I'm calculating credit. I meet all the criteria. The definitions look good, and I still want to produce a memo or something to refer to later in the future, in addition to the calculation that navigate the nuance. So these are super important concepts. The definitions are out there. I mean, there's some guidance. We expect the IRS to issue more guidance. So while we have these FAQs to look to as guidance, they're not law, right? So we do expect the IRS to provide more specific legal guidance that we can rely on. But in the meantime, this guidance is sort of loose. So people are making very interesting arguments. And so we want to make sure we help our clients navigate this credit, which is a big benefit to them, which they deserve if you've been impacted, but also want to make sure that you don't get yourselves into run into any sort of trouble with the IRS. Brent, do you have any questions that were popular that came up, or anything that we want to try to address in the last 10 minutes?
I mean, we knew it was an engaged topic, and that has borne out in the Q&A as well. So we've got 10 minutes, so we won't get through them all, but I'll try to hit some of these, and then we'll try to get back to folks, with additional clarification along the way for sure. So one of the things, Andre, that came up is, several times, eligibility. Once you become eligible in a given quarter, what does that mean about subsequent quarters? Must you kind of always qualify, or how does that work?
That's a fantastic question, and I'm really glad that came up, because there's two distinctions that are really important to bring up, and I'm really glad we were talking about this. So the gross receipts test means once you're established the gross receipts, you evaluate it in that quarter. You reevaluate it every quarter to make sure that you're qualified. In 2020, that 50% decline in gross receipts test gets you qualified. You stay qualified until you're less than 20% decline in gross receipts. So you start at 50%. I had a big down decline in gross receipts compared to 2019. And then I started to come out of it, and maybe I'm like within 25% of 2019 and say Q3. So you're eligible in Q2. You're still eligible even though you're within 50%. So you don't become uneligible until you're back sort of within what they're considering normal levels. So within 20% is now you're not eligible according to the gross receipts test. The partially shut down test, you evaluate it and say, boom, I'm qualified in, say, Q2 of 2020. I was partially shut down due to government order. If you somehow in the same quarter are no longer subject to government order, or somehow your operations are back to normal, you have to calculate that just that window. So say 2 months of Q2, you were partially shut down. You're only able to calculate the credit for that 2-month period. So you have to calculate the wages for the 2 months that you're partially shut down, and it's not automatically you're eligible for the entire quarter. So these are sort of really unique and nuanced things that we have to navigate. And these are super important. And these are the kind of conversations we have when we have one-on-one conversations with our clients and talk about what was your exact fact pattern? How do we navigate these rules? But hopefully that answers the question a little bit, but we could talk about this at length because there are a lot of rules around these definitions.
Yeah, as we've learned in all of these programs, Andre, it is the devil is in the details, and unfortunately, the details are kind of evolving, and we're waiting on guidance. So definitely stay close to us and reach out. That's there's definitely advice we can give. Hey, a good question came up on number of employees. So this full-time thing, Andre. So if you're over 30, you're a full-time employee. What do you do with those folks that are below 30?
Oh, great question. So they are not considered full-time equivalents or full-time employees, so they're not part of your equation. So if you have a bunch of part-time people, and the definition is in 2019, that's when you measure the people, and you're measuring only your full-time employees. So the people that are part-time, they're falling below the 30 hours a week of service in a given month. You take them out of the equation. So say you had 80 employees total, some part-time, some full-time. If only 20 of those employees are part-time, they're not part of your equation when you're calculating your full-time equivalents. That's a great question. Really good.
Great. And then a follow-up. So for those employees that don't fall into that part of the calculation, are their wages wages still eligible for the credit?
Beautiful question. Fantastic. Yeah, they are. So it doesn't really matter once you meet the definition of a small business, right? That's the definition of either 100 or less or 500 or less by that full-time equivalent definition. Now you're looking at, it doesn't matter who they are, you're calculating the credit on. They could be part-time people, they could be full-time people. It's all just qualified wages. So that's a really good question. And something that we navigate with our clients quite often.
Great. And then here's a good kind of clarifying one. I think it was in there, Andre, and we talk a lot about the relevant quarter compared to the relevant quarter in 2019. But there's also this secondary test that allows you in 2021 to do prior quarters. So can you just kind of refresh on that guidance?
Yeah, that's the tricky guidance, and it applies only to Q2. So at Q2 of 2021, instead of trying to figure out waiting for the quarter to end, which actually is today, right? Today is the end of Q2. You look back at Q1 and say, was I eligible under the gross receipts test in Q1? So in Q1 2021, comparing your Q1 2019 quarters together, if in that Q1 quarter you had a decline in 20%, then you can say, I'm using this definition to be eligible for Q2. So it's an interesting new thing they threw at us. But I think the intent there was to say, you don't have to wait till the end of the quarter to tally up all your gross receipts. You can use this alternative one quarter look back method to determine your eligibility for Q2 of 2021. It's not clear if they're going to continue that for Q3 yet. I would expect that they would, but so far it's just for Q2. So it's a really nuanced guidance that we just got not too long ago, but had to throw that in there.
Great, and then I'm going to do one final one and then wrap. And we've got about 60 questions in, and we probably addressed 10 to 15 of those. I've done a couple on the side, Andre, so I'm going to hit you with one more. And again, it's probably a bit detailed, but I kind of want to get it out there because we've seen it several times. If you weren't in business in 2019, are there any special rules for the revenue test, or do you only qualify under the partially shut down test?
Good. That's a good question, and the answer is that they have your own look back. So similar to this new way to look back one quarter, you do that same look back. If you weren't in business in all of 2019, then you can do a 1 quarter look back to see, you compare your most previous quarter to your current quarter, and you do it that way. So there is a special rule for companies who are just getting started in 2019 and weren't around for the entire year, or just starting in 2020. So there are some very specific rules that we can help our clients with.
Great, and that's what I recalled. So I kind of wanted to get that out because I know it's very specific. So definitely, if you guys are, if you have that situation, reach out to us as well. We're on social media. We would love for you to join us. Follow us on LinkedIn or YouTube or Twitter. We're getting information out kind of all the time. Information like this, timely on kind of updates that are ongoing, as well as webinars and things like that where we're giving information. So definitely, feel free to follow us there, and a great way to kind of stay up to date on the latest events going on.